Welcome back. You're with Money, and we are in conversation with Mr. HEMANT Rustagi, trying to understand the right portfolio construct when it comes to mutual funds at different stages of your life. So we've discussed the early investor, we've discussed the middle-aged professional, and now it's time to talk about those who are sort of approaching their 50s and, veering towards the sunset years. How does the allocation change now?
Well, I think it depends on at what stage you started investing, because, let's not forget that retirement planning is one of the most important goals of your life. So this is the phase of your life where you're at the peak of your career. So your income is,
probably at its maximum.
At its maximum.
Yeah.
So this is the time where, by now you would have kind of taken care of most of your responsibilities and liabilities. So you have, maybe don't enough time to invest, but you have a lot of money to invest. So continue that process. And as you approach your retirement age, maybe a couple of years before that, start rebalancing your portfolio. Now, if you were really higher into equity, you need to make sure that you protect all the gains that you built over the years, because that is again the time when you retire, you will have to reassess your requirement in terms of how much will I need in terms of income, because then your portfolio has to move from growth to income generation.
So, there are a lot of people as they approach retirement these days with fixed income not really yielding much, particularly, the good old fixed deposits. They're looking at different options. Is it advisable for them to still have an equity component to the portfolio? In that case, what sort of funds can they go for? What's the right mix between debt and equity then?
I think one of the major mistakes investors make when they talk about retirement, what they're taught is this is a retirement fund, don't take any risk. That there are two types of risk that you take. One is that you don't want to lose a part of your principal. The second one, which is even more important, but we don't really focus on that, is the risk of inflation. The fact is that somebody is going to live for another 25 years after, let's say, retirement. How is your money going to keep pace with inflation?
Yeah.
When you go for these FDs or bonds, you lock your money.
Yeah.
You compromise on liquidity. The returns are low. Fixed, okay, there's no growth in that. Third is returns are not tax efficient. So it's very important, even after retirement, to have certain part in equities, maybe 20-25%, depending on what is the shortfall or what kind of regularity of income that you have. You must have that. At the same time, the biggest challenge at this stage is how do you generate income?
Right.
The problem is the ones which give you fixed return. We have post office monthly income scheme. The bank give you quarterly or monthly or half yearly interest, but like I said, they are not actually tax efficient.
Yeah.
The moment you come into a market linked product like mutual funds, there are two risks. One is the return that you get can vary, even though there is a potential of getting higher return. So you must keep that in mind.
Yeah.
So you should have even the traditional options in your portfolio. At the same time, there is a place for this market-linked products. This is something that every investor need to keep in mind. So what are the options? We did talk about balanced fund, for example. Most of the balanced funds are giving you monthly dividend. Most of the equity saving funds are giving you monthly dividend. But there is another category of fund which used to be very popular but it's lost its sheen now, is monthly income plan. And the reason for that is that there is a dividend distribution tax of 28.33%, which means that if you are someone who is not paying any tax because your income is not that much, or if your tax bracket is, let's say, 10% or 20%, you end up paying much higher dividend distribution tax. So that's where there is another option that mutual funds offer, which is a beautiful option. It's called systematic withdrawal plan. What investors need to do is they can register for systematic withdrawal plan, wherein you give instruction to the fund saying every month, redeem units worth 10,000 rupees. So what you do is, whatever fluctuation that you may see in the return, that goes away. You build your corpus over a period of time. By then it would have become long-term capital gain. When you start withdrawing money, you're not paying tax on that.
So there's no taxation on the withdrawals that you're making every month?
It depends. If it's pure equity fund, then obviously no. If
after 1 year
fund,
at least, there'll be no
If it is equity saving fund, no. If it's a debt fund, other debt fund, there will be long-term capital gain if you're completed 3 years. So there will indexation benefit. I think the tax incidence is going to be, if at all, very, very low.
But we must keep in mind that the tax incidence becomes zero or very nil only after 1 year in the case of the equity plans, as you mentioned, and only after 3 years in the case of the debt funds, right?
Yeah, like I said earlier, any fund which has exposure of 65% or more in equity is equity. So there, after 1 year, becomes long-term capital gain, no tax. The dividend is also tax-free, and there is no dividend distribution tax paid by the fund. All other funds actually have to pay dividend distribution tax. So it's very, very important. We did mention about choosing the right fund. I think it's equally important to choose the right option. Many investors make the mistake. Suppose you want to build a corpus over a period of time and you opt for a dividend payout. A significant part of your money will come out and you'll end up spending somewhere. So you must have growth option there. But if you are looking for regular income, you can go for dividend payout.
So some examples for those who are approaching retirement, the sort of funds that they should keep in mind?
Well, some of the funds we already discussed about, equity saving fund. We have talked about Quota Equity Saving Fund, Reliance Equity Saving, and SBI Equity Saving. And in the balance fund, again, we mentioned 3 funds already. So these are the funds that investors can look at. But I'm not saying that all your money has to either go into, equity saving or hybrid fund. There is a place for the debt funds also in the portfolio. So again, debt fund can be a part of your integral part of your portfolio at the time of retirement. So some of the funds, like you have income opportunity fund, you have Kotak income opportunity fund, okay, you have a Reliance regular saving debt fund. So there are a number of funds even in that category.
Okay, so any final thoughts or any final tips that you'd like to leave our viewers with when it comes to sort of planning the portfolio and also evaluating that portfolio? Over what periods of time should you typically evaluate your portfolio without getting panicky and also taking the right decision in case you need to churn?
Well, I am of the firm belief that mutual funds is the best option. One, because they allow you to invest in different asset classes. Within each asset classes, there are a variety of funds. The only important thing is that you must know what your requirements are. You should pick and choose the right fund in the right quantum. Keep an eye on your portfolio, and don't forget that when you talk about long-term investing, your commitment is to the asset class, not to the fund. Many times investors make the mistake, okay, I've invested in this fund, so what if it's not doing well? It will do well after 5 years, 10 years. I think that's not the right thing. I would say from the point of view of making changes in the portfolio, once a year you must have a look. Okay, and if your fund has been performing well, and if it doesn't do well for 6 months or 1 year, try and ascertain what is the reason for that. Maybe the segment that is investing in is not doing well. Maybe the philosophy it is following is not doing well. And if you still believe in that philosophy, there's no reason for you to exit from there. That's why within equity, you must have funds following different philosophies. So keep an eye. Just don't look at 6 months or 1 year performance and say, let's get out of this. So it's important to have the right fund. I think 50% of the job is done if you choose your fund right at the beginning. And I think it's important to also focus on time diversification. We always talk about diversification in the portfolio. Time diversification is equally important. What it really means is stay invested during different market cycles. There are cycles which are going to help you a lot in the long run. But that's the time when most investors actually exit from equity.
All right, be smart, be patient, choose the right fund, and then stay invested. That seems to be the advice. Thanks so much, Mr. Rustagi, for joining us on the show today. Well, that's all we have for you on this week's edition. All the feedback, queries, and comments are welcome. As always, we'll see you again next week.